Bob Farrell established himself as one of Wall Street's top market analysts over his many years as Merrill Lynch's head of research. His observations on technical analysis and overall market trends were codified in the book 10 Market Rules to Remember, and have since been extensively disseminated. Here, we discuss 6 axioms that have stood the test of time and how they might improve your results. Before starting, subscribe to our channel for future updates. Let's start. Number 1. Markets return to the mean over time. Markets eventually return to more sensible, long-term valuation levels, regardless of whether they encounter extreme optimism or pessimism. Reversion typically returns the market to a former state, in accordance with this idea, and returns and prices will go back to where they originally came from. Therefore, the lesson for individual investors is simple: create a plan, and adhere to it. Use your best judgment and attempt to balance the importance of everything else that is happening in your immediate environment. Don't let the everyday commotion and turbulence of the market overwhelm you. Number 2. Excess leads to an opposite excess. When markets overreach, we may anticipate an overcorrection, much like a car being driven erratically by a young person without expertise. An overcorrection might result in larger moves, since a correction is defined as a change of more than 10% from an asset's peak price. Investors are given extremely fantastic buying opportunities during a market meltdown. However, they frequently overcorrect in either a downward or an upward direction, and trading can reach unimaginable heights. Aware investors will be cautious of this and will have the time and knowledge to take prudent measures to protect their cash. Number 3. Excesses are never permanent. Even the most successful investors have a propensity to think that their potential for profit is endless when things are going their way. Nothing lasts forever, especially in the financial sector, thus that statement is simply untrue. After all, as the first 2 principles show, markets revert to the mean, so you might need to act at some point. Number 4. Market corrections don't go sideways. Markets that move quickly often correct quickly, which can make it difficult for investors to calmly consider their next move. The takeaway is to set stops on your trades to prevent emotional reactions and to be decisive when trading quickly changing markets. When asset prices move past a certain point, stop orders can assist traders in 2 different ways. They can assist investors in limiting the amount of money they lose or in helping them lock in a profit when prices fluctuate, in either way by identifying a specific entry or exit point. Number 5. Public buys most at the top and least at the bottom. The ordinary investor follows market programs, reads the most recent news on their phone, and trusts what they are told. Sadly, by the time the financial media reports on a particular price shift, the move has already been completed, and a reversion is usually underway. John Q makes his decision to buy at the top or sell at the bottom at precisely this point. This guideline emphasizes the necessity of being a contrarian. Herd mentality never outperforms independent thought. Number 6. Fear and greed. Stronger than long-term resolve. Successful investing may be most threatened by basic human emotions. But regardless of whether you're a day trader or a long-term investor, success in trading depends on having a disciplined attitude. With each trade, you must follow your trading strategy. You must be well aware of both the upside and downside levels at which you are selling your stock. It is far harder to know when to exit a transaction than one is to know when to enter it. Security that's moving swiftly, fear and greed act quickly to distance you from reality and your money. Number 7. Markets. Strong when broad, weak when narrow. While concentrating on popular index averages has many benefits, the underlying strength of the market as a whole determines the strength of a market move. Therefore, larger averages provide a more accurate assessment of market strength. Because of this, it can be beneficial to track other indices, at least ones that are distinct from the S&P 500 and other well-known benchmarks. To better understand the health of any market movement, think about keeping an eye on the Wilshire 5000 index or a few of the Russell indices. The almost 4,000 American companies that are traded on an American market and whose pricing is open to the public make up the Wilshire 5000 index. The Russell 1000 and Russell 3000 indices, which are weighted by market capitalization, provide investors with exposure to the American stock market. Number 8. Bear markets have 3 stages. Both bull and bear market action exhibit the same patterns, according to market technicians. Prices often decrease by at least 20% during a bear market. Weak or slowing economic activity is typically the cause of this type of market. The so-called suckers rally follows this. Prices that spike swiftly before making a sharp drop to the downside again can attract investors to the market. These rallies, which can be the consequence of rumors and hype, are brief. Who are the fools, though? The investors, naturally. They are referred to as suckers because they might invest during brief price spikes but lose money when asset values fall. Number 9. Be mindful of experts and forecasts. It's not magic, though. There are no more buyers once everyone who wants to purchase has done so. The market must turn lower at this moment. Similar to when everyone who wants to sell has done so, there are no longer any sellers. So, when market analysts and projections advise you to sell all you have or buy everything you can, make careful to realize that everyone is going on that bandwagon. And there is nothing left to sell or buy. By the time you intervene, something else is probably going to occur. Number 10. Bull markets are more fun than bear markets. Since prices grow at these times, this is accurate for the majority of investors. Who doesn't enjoy watching their revenues grow? Unless you're a short seller, that is. Selling an asset that you do not personally own is known as a short sale. This approach is used by traders who sell borrowed securities in the hope that the price would fall. Then, in the future, the seller is required to repay an equivalent number of shares. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe our channel for future updates. Thanks for watching.